Good morning, students. Today we will be discussing on international financial management. So far, we have already understood financial management in our intermediate syllabus as well. We know that financial management is all about sourcing the requirements of finance and making a right investment decisions. Now we have added a word international to the financial management. So we will look at all the sourcing as well as investment decisions, considering the fact that if we are going to make investments in different countries around the world, if it is a multinational operations and when foreign currency is involved. So just like financial management, we will look at capital investment decisions based on international finance. We'll discuss the how we manage the cash in international finance, how we manage the working capital, receivables, and inventory, and everything. So let's start with some questions here, which will help you understand what is international financial management. So, if we look at the sources of international finance, we can have money from foreign sources also, which means that you can borrow from foreign sources, you can issue foreign currency convertible bonds. So we understand what are convertible bonds, right? Which can be converted into equity at a later point of time. But when I say foreign currency convertible bonds, the difference is that the issuer will be able to raise the money in foreign currency. Similarly, there are certain options like ADRs, GDRs, which are depository receipts. So, depository receipts are also your negotiable instruments where the issuing company is able to have access to be able to share its equity in international markets or different countries. How it works is that when you have your shares, you can deposit those shares into to a custodian bank in your local country, and this custodian bank will ensure that a depository in a foreign country will be able to distribute the depository receipts to the investors in that foreign country in the currency of the foreign country. So when we talk about these depository receipts being issued in US, they are called American Depository Receipts or ADRs. Elsewhere, it is called as Global Depository Receipts, GDRs. So ADR and GDR, IDR, all these are depository receipts depending upon in which country the money is raised from based on the equity shares of the issuing company. So let us discuss this first question here, and we'll gradually understand how international financial management questions are solved. X Limited is interested in expanding its operation and planning to install manufacturing plant at US. So we expecting X Limited to be an Indian company, and this company is trying to expand its operations and install a plant in US. For the proposed project, it requires a fund of $10 million. So the money required in foreign currency is $10 million, and 10 million is required net of issue expenses. So whenever you are raising shares, whenever you are issuing shares, equity, preference, or even issuing any other securities, there are will certain expenses of flotation cost which is incurred along with the issuing of those instruments. So we don't want to have a gross amount of $10 million. We want to have a amount of $10 million after covering all the issue expenses as well as the flotation cost. So what we should have in hand is $10 million. And the estimated flotation cost is 2%. So here there will be a small working note that how much do we require to issue. So amount in dollars to be raised, so that after the flotation cost, after the issue expenses, we are still left with $10 million. Okay, so flotation cost is how much? 2%.
2%.
Right. So what we will have in hand is only 98%, right? After deducting, if we issue 100 rupees and if 2 rupees goes as a flotation cost, what is left in your hand is 98%, which can be represented in decimal terms as 0.98. Now we want this 98% to be equivalent to $10 million, right? So amount to be issued will become 10 million USD divided by 0.98, right? So this is the amount we are going to raise in the American market. You need to issue 10.2041 millions. It's 408. I have rounded off to 2041 millions. So the first thing that is required to be able to do these questions is that we have to find out how much should be the amount we will issue in GDRs, how much is the amount we'll raise in foreign currency. So that after covering the issue cost also, the flotation cost, we are still left with the amount that we need. And what do we need? We need $10 million net. So 10 million divided by 0.98, we will be required to raise US dollars 10.2041 million. Now you as a financial consultant is required to compute how many GDRs to be issued and what will be the cost of the GDR with the help of following additional information. So how many GDRs? We do know that we have to raise $10.2041 million, but how many GDRs? For that, we will look at the issuing company's local shares, equity shares. We'll see that the market price of the share at the time of issue is 250 rupees. So the assumption X Limited is an Indian company comes right here because the market price of the share in Indian rupee is 250 with a face value of 100 rupees. However, two shares will underline each GDR. So it's not that one GDR will have only exactly one equity share. It can have 2, 3 or 4 or as many as given. So that each GDR will be having an underline of 2 equity shares, but they'll be priced at 10% discount to the market price. So let's see how much is each GDR. 200. Each equity share is 250. Therefore, if you have 2 shares in each GDR, the total market price of the GDR is 500, but we'll have to give 10% discount. Indirectly, it implies that we will be able to have 450 rupees per GDR. The market price that or the price at which we are going to issue the GDR is 450. Now, the amount to be raised is $10.2041 and the GDR is rupees 450. So let's convert how rupee 450 is equivalent to how many dollars. The expected exchange rate is given when you are going to issue the GDRs, that is 60. So each GDR would be for how much rupees, how much dollars? 450 divided by 60. So with each GDR, you're going to raise $7.5, right? So we are being asked certain questions. What is expected market price of the share at the issue? We are going to say 2 shares are underlying each GDR with a priced at 10% discount to market price. Expected exchange rate is 60 rupee per dollar, which means with each GDR, we will be able to raise $7.5. And the dividend that is expected to be paid is 20% with growth rate of 12%. This part of information will be relevant to us when we will be calculating the cost of issuing the GDRs. Okay. So you're required to compute one, number of GDRs, and second, cost of GDR. So let's start with calculating. Solution part 1, number of GDRs. To be issued, to raise $10 million net. So dollars to be raised, $10.2041. Right? So you will refer to this working note. And similarly, what is the cost of each GDR? This will become your second working note. $7.5. Okay. Right. How did we get to working note 1? 10 million divided by 0.98. And working note 2, since each GDR comprises of 2 shares with a market price of 250, so it becomes 500, less discount 10%. So the value of GDR in Indian rupees becomes 450, and exchange rate expected rupees 60 per dollar. Therefore, value of GDR in dollars, 450 divided by 60 is equal to $7.5 per GDR. So how many GDRs to be issued? $10.2041 divided by 7.5. So 1.3605466 million GDRs. Rounding off, it becomes, let's say, 1.3606 million. We will mention that we have rounded off till decimals of, or we can say 4 decimal places. Okay. So 1.3605 million GDRs must be issued in order to get a net value of 10 million. You can round it off to next higher number also. That will be more realistic here. Reason being, you need to raise at least 10 million, right? So if you round it off to 0.5, it becomes a little less than your required amount. So if you round off to 1.3606 million, you will be able to raise at least 10 million. Part 2 says what is the cost of issuing the GDRs. So if you remember, we have one formula where we calculate the cost of equity using the dividend price model, which is D1 upon P0 plus growth. So similarly, here also we'll calculate the cost of GTRs using the same formula because the underlying is equity only. So for this we need, what is the next dividend? We need three information. What is the next dividend? You may call it next dividend, expected dividend, or dividend after 1 year. So you have to be very careful in the question whether it is saying expected dividend, net dividend, or current dividend. If it is saying that the dividend just paid or current dividends was a certain figure, that means D0 is given, not D1. Okay. So if D0 is given, D0 has to be converted into D1. How? D1 will be equal to D0 1 plus growth rate. So first thing that you will be careful in doing these questions is to read carefully whether the question is giving you D0 or D1. Here it is said expected to be paid is 20%. So when it said expected to be paid, that is what we need, D1. However, it's not given as an absolute figure, it's given as a percentage. So whenever dividend is given as a percentage, you will read the face value of the share. If the question is silent as to the face value of the share, you can assume 100 or 10, whatever you think appropriate, which will also to some extent depend upon what is the market price of the share. So here as the market price is 250, I could have assumed 100. Even if I assume 10, there is absolutely no problem in the sense a 10 rupee share can also move to 250. But then here it is specifically given, so I don't need to make any assumption as to the face value of the share. So the face value of the share is given as 100 and a dividend of 20% on 100 becomes 20. So your third working note would be D1, calculation of D1, which you will mention as 20% of face value of 100, which is equal to 20. So now you have dividend, which is equal to 20. But remember, we are calculating the cost of GTR. We are not calculating the cost of equity. So each GTR comprises of two shares, right? We have seen here 2 shares constitute 1 GTR. So the dividend on 1 GTR would be 20 into 2, that is rupees 40. So D1 we have found, that is 40. Now we want the price of the share or the net proceeds. So once again, what net proceeds are we getting from the share? We are getting 2 shares net proceeds are 450 because we are giving them at a discount of 10%. Further, remember there is a flotation cost of 2%. So even this 450 is not what you are getting as a net proceed. You will have 450 minus 2%. So from this 450, a 9 would be deducted, which is 2%. Okay. So cost of GTR would be 40 divided by 441. 441 comes from where? 450 minus 9. Okay. And plus growth. Now 40 by 451 is a decimal. So growth will also be taken as decimal. So how much is the growth? 12%. Converted into decimal, we'll call it 0.12. That will become your part of second answer, the cost of issuing GTRs. So 40 divided by 441, this fraction comes out to be 0.12. 0907 and plus 0.12. The cost of GTR is 21.07%. Right? So I hope this is clear. How you calculate the questions which are related to GTR. Right? 10 million is to be raised, but there is a flotation cost of 2%. 10 million is to be raised net. So the total amount to be raised would be 10 divided by 0.98, 10.2041. Then how to raise this 2041? By issuing GDRs. Each GDR comprises of how many shares? 2 shares. What is the face value of the share? 100, but the market price is 250. So you will be able to raise 250 from the market. 250 into 2, 500 is the price of each GDR. But as we are giving 10% discount, so 500 minus 10%, we will be raising the GDR at 450. The value of GDR in Indian rupees is 450. Calculate or convert it into the US dollars. As the exchange rate expected is 60, 450 divided by 60, each GDR would be issued at 7.5. So the total number of GDRs that are required to be issued is 10.2041 million divided by $7.5. It comes out to be $1.3605 million. So rounded off to 1.3606. Next higher fraction. Second part was cost of issuing the GTR. So for that we need D1 by net proceeds or P0 you can call it. So whenever you are writing any formula using, mention where D1 is the next expected dividend, P0 or NP is the net proceeds from issue of GDRs, and G is the growth rate. So 40 on 441 plus 0.12. So the cost of issuing a GDR comes out to be 21.07%. Okay, we'll do a similar question so you will be able to understand things absolutely properly. Let's do a little working here. Messrs. Raghu Limited, interested in expanding its operation, planning to install a manufacturing plant at US, requiring 8.82 million. Once again, net of issue expenses of flotation cost. And the GTRs are expected or proposed to be issued to finance the project. Flotation cost is 2%. So once again, your first working note, gross issue size or whatever you want to write here.
Madam, just increase your font size.
All right, sir. I'll do.
It is very small.
Okay. Give me a moment.
Madam?
Yes, I'm doing so.
Madam, mainly I am talking about the writing.
Oh, okay.
Okay, just write little.
Writing.
Okay, yeah, because
I'll do that.
okay, it is okay. That is because assignment with the student with them, it is not a issue.
Okay.
Just writing.
All right, I'll take care of that.
Not on a madam separate sheet, if possible.
I am using the separate sheet also, but I'm just showing the workings here.
Just you okay.
Okay.
Or just increase the font size.
I will.
Okay, of your writing. Okay.
Sure. So team, here first we are having working note 1. So what is the gross issue size? So the gross issue size here would be 8.82 million USD is required, which is net of issue cost. So when this is divided by 0.98 once again. Why? Because once again the flotation cost is 2%. So 8.82 divided by 0.98. This time we are required to raise exactly 9 million US dollar. I hope it is visible and clear now. Okay. So the total amount to be raised is $9 million, so that from this $9 million, even after giving a 2% flotation cost, we are still left with 8.82 millions, which is our required investment in the foreign project. Now, how many shares or will be underlying the GDR? That is the first information we need. We have 2 underlying shares. Second, what is the market price of the share at the time of issue? Each share is of 360 rupees market price. Next, the face value of the share is 100. This would be relevant to us if the dividend is given in a percentage form. So the GDR is having 2 shares, each share of 360, but the issue price is at 10% discount. So once again, we'll calculate the what is the value of each GDR using the exchange rate of $1 is equal to 72 rupees. Right? So these 3-4 information together will tell us how many GDRs we need to issue. So we need 9 million, that is clear. Now the value of 1 GDR, the value of 1 GDR would be 360 into 2. So each GDR will comprise of 2 shares having the market price of 720 less 10% discount. So we'll deduct 72 from here. That means each GDR would be 648. Right? So each GDR will be of 648 rupees because 360 multiplied by 2, that means we are going to have 720 as the price of the GDR in terms of rupee. However, after 10% discount, the price of the GDR would be 648. Now convert the 648 into US dollar. 648 rupees, and each rupee is dollar is equivalent to 72 rupees. So 648 divide by 72. The price of each GDR in terms of dollar would be equal to 9. Right? This will become your second working note. Next we'll do later. Let's complete this part. Number of GDRs. Amount to be raised. In millions. So 8.82 divided by 0.98, that is 9 million US dollar. Price of each GDR in dollars. 2 into 360 into 0.98 divide by 72. You can calculate it separately in the working note or you can calculate Here it's $9 per GDR. So the number of GDRs to be issued is 9 million divided by 9, 1 million GDR. So we need to issue 1 million global depository receipts. When we issue 1 million global depository receipts, each GDR is for $9. So we will get $9 million. And after deducting the 2% flotation cost, we will end up having 8.82. Now, dividend is expected to be at the rate of 20%, still same. Growth is again 12%. Face value is again 100. So, the cost of issuing the GDR dividend divided by net proceeds plus growth, which means once again 20 is the dividend, 20 into 100, 20% of 100, 20 rupees each, 20 into 2, that is 40, and that is the expected dividend. So once again D1 is given, not D0. If it had been said here, dividend just paid was 20%, then the D1 would have been 40 into 1.12, right? So here the dividends are going to be 40. Net proceeds are going to be, once again calculate, 2 shares of 20 each, 360 each, sorry, 720 less 10%. So 648. And then what we are going to have in hand is less 2% flotation cost. So 648 minus 2%, further 12.96. So the price of each GDR is 634.5.04. So what are the net proceeds we are going to get from each GDR is 635. As the dividends are taken in terms of rupee, let's take the price of the GDR also in terms of rupee. So 40 divided by 635.04 and 12% growth rate. So plus 0.12. You can also convert it into 100% here, multiply by 100, 40 divided by 635.04 into 100. If that you do that, you have to add 12. So whatever you follow, it's up to you. 40 divided by 635.04. This is 0.6298. Nine rather, plus 0.12. So the cost is coming out to be 18.298, or we can say 18.30% approximately. So the cost of issuing GDR is 18.30%. Right? So fifth part is done. What is asked? You as a financial consultant are required to compute the number of GDRs to be issued and cost of the GDR. This we have done. The GDRs that are required to be issued is 9 million or 1 million GDRs, and cost of issuing GDR is 18.30%. Second part, what is your suggestion if the company receives an offer from a US bank which is willing to provide an equivalent loan with an interest rate of 12%. So if you look at this part of the question, the loan is costing us 12%, whereas the cost of issuing the GTR was 18.3. When you borrow, you also get the tax benefit sometimes. So here, if you compare 12 with 18.30%, it is lucrative to have a loan with an interest rate of 12%, which is less than 18.3% cost of GTR. So loan appears to be a cheaper option, but you will also consider other factors like what is the existing financial leverage. Third part, how much company can save by choosing the option as recommended by you. So firstly, if we assume that the loan taken would also be of $9 million, assuming 2% charges or expenses even in raising loans. So if we compare 12% on 9 million, you end up paying 1.08 million as cost. Whereas if you take the 9 million through GDRs, the cost comes out to be 1.647 million. So how much can the company save if you choose an option as recommended by us? That is, go for loan. The amount that would be saved is 0.567 million or $5,67,000. Okay, so we'll do this part here. Cost of loan, 1.08 million. Cost of issuing GTRs, so by taking loan, the company can save $0.567 million. Okay, you may convert it into rupee also. Further important is that you mention that it has been assumed that the loan raised would also be of 9 million, assuming a 2% flotation cost there also, as well as the fact that there could also be further tax benefits, but we'll also have to look for the leverage which is existing with the company. Right? So this is your part of solution, question number 2. I hope this is clear. Almost similar to the first question. However, there were 2 extra questions asked here. One, how will you compare it with the loan which is available at 12% interest rate? And second, how much the company will save if you choose the option as recommended by the solution that we have given. So the first thing, second part answer is the company should go for a loan as it is a cheaper means as compared to GTR. And how much the company would save is 9 million into 12% and 9 million into 18.30%, effectively 6.30% on 9 million, which is $0.567 million. Right? So these are certain questions which are there on GDRs, and these are oft repeated questions which can likely feature anytime. And you have to take care of how much of the amount is to be raised, whether it is net or gross. Second, you have to look at the market price of the underlying shares. Third, you have to be careful about looking at how many shares underline the depository receipt. Is it 2, 3, 4, whatever the given figure is. Then you have to convert it into your foreign currency also and find out how many depository receipts are required to be issued. To calculate the cost of the depository receipt, you can calculate it in the local currency by looking at how much would be the expected dividend and what are the net proceeds. In calculating the net proceeds, do not forget to deduct the flotation cost, as that would always be there, and add to it the growth rate. That would be your cost of issuing GDR. Now let's look at some other type of questions. Particularly, these are related to the total capital investment that we are going to make. So when you are making a capital budgeting decision or an investment decision, you have to look at 2 or 3 possibilities can be there in international financial management. The first scenario or the possibility can be that there is a foreign company which is trying to come and invest in India, or one country approaching another country and making investment is there. Second possibility is that an Indian company may be wanting to invest in any other country, US, UK, anywhere else. And then the amount that is required is also invested in foreign currency, raised in foreign currency. So we have to look at those scenarios and calculate once again the NPV, which is the net present value of a project. But this time we will do it as an international financial management. So there would always be a different currency involved. And while evaluating the projects also, when you are calculating the NPV, you must take care whether the question is specifically asking you to calculate in a foreign currency or in the local currency. If not, you can calculate it as per your convenience, as in the local currency, it would be more better approach for you. So calculating the NPV of the project, but here it is specifically saying using the foreign currency approach, right? So we'll not convert the dollars into rupee, even if the exchange rate is given rupee 48 per US dollar. We will first calculate the entire calculations would be done in terms of US dollar only using the foreign currency approach. So let's first read this question. Question 3. ABC Limited is considering a project in US. So ABC Limited is wanting to make investment in US, where the initial investment would be of US dollar 1 crore 10 lakhs. So it's 11 million, right? So $11 million would be invested. This is your initial investment. Life of the project, another important aspect, 5 years. Current spot rate 48 per dollar. Risk-free rate in US is 8% and the same in India is 12%. Remember, this is risk-free. So when you are evaluating any project, it must have certain risk in this. So if you are looking for a risk-free return of 12% with some risk in the project, you are looking for a return of not 12% but 14%. So we are supposed to calculate the NPV of the project using foreign currency approach. Required rate of return is 14%. That means if we look at as a layman, a 2% risk is perceived, 12% risk-free and 2% extra do we want. So we are saying that the premium that we associate with this project for risk is 2%. However, there is another way to calculate risk-free multiplied by risk premium. Would give you the appropriate cutoff rate or discount rate that is required. Okay. So risk-free plus risk premium will give you the required discount rate. Here the risk-free is 1.12 in India. The risk premium, we don't know. We will calculate that. And this totals to 1.14. So this will become your first working note. Calculation of risk premium. A rough idea you will get when you compare 12 and 14, but to be exactly able to calculate, risk-free multiplied by risk premium will give you the required discount rate. So risk-free for India is given as 1.12. The required return from the investment is expected to be 14%. So how much is the risk premium? 1.12 multiplied by 1 plus risk premium should give you 1.14. So how much is the risk premium? It becomes 1.14 divided by 1.12 minus 1. That will give you the risk premium. So this turns out to be 0.178, or if you don't want to subtract the risk premium here, 1 from here, ignore this and you get 1.0178. It's at 5, so you can take it as 1.0179. Rounded off till 4 decimal places. This is the risk premium. Now, important thing in this question is you are going to use foreign currency approach. So we will evaluate the NPV of the project using dollars. So the appropriate discount rate or required rate of return from the project, which is 14% in India because of 12% risk-free returns, will change in US because in US the risk-free rate is 8%. However, the premium associated with the project for the risk will remain same at 1.0179. To explain this again, what is the risk-free return in India? It's 12%. And what is it in US? It is 8%. Whereas the required rate of return project is how much? 14%. So why this 12 has become 14? Because there has to be some element of risk premium. As a layman appears to be 2, but we have calculated using the multiplication approach. So it's coming out to be 1.79. Okay. So 1.79. 1.79, yeah. How you will calculate 1.79? Because the factor is 1.0179 minus 1 into 100. Now, at what rate of discount or what will be the required rate of return from the US? The US has a different risk-free, but the risk premium associated with the project will remain same. So this should give us the required rate of return from project if we are evaluating NPV in foreign currency. So as a layman, it may appear 2%, so 8 and 1.79 you can simply add, but we'll do a more practical approach. 1.08 into 1.0179 is the required rate of return from the project in dollars. So 1.099332. Rounded off to 4 decimals, 1.099. Or we can round it off to 3 decimals only. And therefore, the applicable rate of return required would become 9.9%. Or you can also take 9.93%. Is this aspect clear? I hope it is. You are considering a project in US. Investment is 11 million. Project will have 5 years of life. Expected spot rate is given. Risk-free in US is 8%, while in India it is 12%. The required rate of return on this project is 14%. So this helps us in calculating the risk premium associated with the project. And that same risk premium, when applied to the US risk-free interest rate, will give us the percentage or the discount rate at which the NPV of the project must be evaluated. Okay. So then it becomes simple, I guess. We can show the solution here itself. You have cash inflows, US dollar. This is 2 million, 2.5, 3, 4, and 5 million. All right.
I have a question.
Yes.
When we added 12 to 12%, we added 1.79%.
Okay.
It should come 13.79%.
Okay.
It is showing it as 14%.
So that's what I was saying. We are using the multiplicative approach. Remember, we had taken a situation where we talked about nominal rate of interest and real rate of interest.
Yes, remember.
Yeah. So nominal rate is always equal to real plus inflation. So if nominal rate of interest is 10% and inflation is, let's say, 3%. So as a layman, you can say that the real rate of interest is 7%. But that would not be the exact answer here. 7% would not be the real return. It would be a little less than 7%. So how we calculate that? Let's say a thing which was of 100 will now become of 110, right? The money which you invest. So your investment grows from 100 to 110 if the nominal rate of interest is 10%, right?
Yes.
Whereas your product which was of 100 will now start costing you 103 because of inflation.
Right.
So when earlier you were buying one product, now how many product you can buy? 110 divided by 103. Okay.
Right.
So cost of each unit is 103 and you have 110 rupees. So you can buy 110 divided by 103. You can buy 1.0679. So 1.0679 is increase from 1. So how much you have really gained? 6.79%. So it's not 7%, 6.79. Okay. So the right way to calculate is 1 plus nominal divide by 1 plus inflation minus 1 into 100. So as a layman, we can see that there is a 2% risk premium. What was said, risk-free is 12%, but we need a 14% return. Okay. So if you really want to have an approximate idea of how much is the risk premium associated with this project, appears to be 2% when you use the additive model. 12 plus 2% becomes 14, right? But we have to add some risk premium. I didn't mean mathematically, arithmetically exactly add. Add the risk premium associated with it. So risk-free return required is 12% and the risk premium associated with the project is 1.79%, not exactly 2. How did we get that? Because we want 1.12 multiplied by 1 plus risk premium should give us 1.14. Okay?
Yes.
12% is
Good.
okay, but we want certain risk premium also. So that should give us 14%. So how we calculated the risk premium? 1.14 divided by 1.12. Just like here we can divide 1.10 by 1.03. So 1.14 when divided by 1.12, the risk premium comes out to be 0.178. So 1.79%. Right? So the idea is, because the question is saying that you have to calculate the NPV of the project using the foreign currency approach. Okay? We have to use the foreign currency approach. So it means the calculations have to be done in US dollar. The outflow is also 11 million in US dollar, and cash inflows, the nominal cash inflows are also given as under US dollar. Now we need to calculate the NPV. Had this been a simple question in rupees, we would have just picked up the 14% from here and found out the present value of 14% at various years and multiplied, and we would have got the answer. But the whole question revolves around two things. Number one, foreign currency approach is to be followed. Secondly, risk-free rate in US and India is given, whereas ABC Limited as an Indian company requires a return of 14%. So the premium associated, risk associated with this project is demanding that the required rate of return is not 12, but a little more than 12, 14%. So as a layman, we can see that there is a roughly approximately 2% risk premium. But to be able to exactly calculate how much is the risk premium with this project, 1.12 plus 1 plus risk premium should give you 1.14. So the risk premium factor becomes 1 plus risk premium is 1.01785, which we can round off to 1.0179, 4 decimals. Right? Now, this risk premium will still remain the same as it is associated with the project. But the risk-free rate that we will use is of US. Okay? Because all inflows, outflows are in terms of US currency. So we will use the US dollar 8% risk-free return. So the same dollars, for this, the discount rate applicable will be not 8%, not 12%, not 14%, but it will be the risk-free rate prevalent in US multiplied by the risk premium associated with the project. Okay. So the discount rate applicable would be 1.08 into 1.0179. It is 1.0993, or we can take it as 9.9%. Right? Now this becomes a simple question. US dollars are given in the various years. Initial outflow is given 11 millions. Discount rate at which the NPV is to be calculated has been calculated at 9.9%. Okay. So let's evaluate the project. I hope it is clear now how we are arriving at 9.9%.
Yes, very clear.
Okay, great. Calculating. Year 1, 2, 3, 4, 5. Cash inflows are 2 million, 2.5 million, 3 million, 4 million, and 5 million USD. Present value interest factor at 9.9%. So you can calculate those present value factors and you can round off up to 4 or 3 decimal points, but whatever you do, you must mention. So it's 0.9099 0.82795 or 8280. Zero 0.7534.
The next would be 0.6855.
Okay, thank you. Perfect. And next, I'll assume
0.6238.
0.6238.
38. Yes.
Right. So present value of cash inflows. $2.742. Once again, in million US dollar. $2.07. Always when you are doing these calculations, you should always apply your mind to some extent to have an intuitive rough idea of what the value should come out to be. Because if in just doing in haste or in under examination pressure, if something has gone wrong, you are able to track it there and then instead of once you complete the entire solution and then find out things. Okay, like 5 into 0.6 would be 3 something. 4 into 0.6 would be 2.5 or 2.4 something, right? So rough idea should be there that you can always keep in mind and then apply it. So 1.8198 plus 2.07 plus 2.2602 plus 2.742 and plus 3.119. So your present value of inflows is 12.011, whereas initial investment $11 million. So you stand to have a positive NPV of 1.011 million US dollars. You have evaluated the project in foreign currency, but finally, as you have calculated the NPV is what you have at present, and the current spot exchange rate is 48. Now you can convert the 1.1 million which you have got multiplied by, therefore the NPV of the project for the company would be 1.011 into 48. So the company stands to gain 48.528 million rupees. Okay. So it's worth accepting the project because the inflow is certainly quite good enough for us to have the benefit. Okay. The NPV is positive 1.011 million US dollar, and then when you convert it into rupee, you will get 48.528 million. Any doubt or any questions here? How do you arrive at 9.9? That would become a very extensive working note here. Applying the risk, finding out the risk premium, and then applying that risk premium to the US risk-free rate of interest. So you end up getting 9.99%. Okay. 9.9% using the present value factors at 9.9%, rounding off to 4 decimals. The present value is positive. NPV is 1.011 million US dollar. Therefore, NPV converted into rupee is also 48.528 million. The project is worth accepting. All these inflows are expected to be nominal inflows, which you will be receiving over a period of 5 years. Right? So team, if you want, we can take a short break of 10 minutes here, right? And then we can start the next type of questions, which will be a little detailed and lengthy. So we'll understand them and we'll come on to the solution for that, right? Or shall we take up one more question first?
Yes, we can take another question.
Okay. So let us look at this question and first understand this. Question is, there is a USA-based company. This company is planning to set up a software development unit in India. Now, a foreign company is coming and investing in India. What they want to do is they want to develop a software development unit in India. Whatever the software development that will happen in India will be bought back by the US parent at a transfer price of US dollar 10 million. So what will the US company do? It will buy the entire software from the Indian company or the Indian subsidiary where it has set up the software development unit, and the transfer price has been agreed at US dollar 10 million. This unit will remain in existence in India for 1 year. So the entire software is expected to be developed within a 1 year time frame. So the software is expected to get developed within this time frame. So far clear? The crux of this becomes that a US company will set up a software unit in India, software development unit. Whatever the software it develops will move back to the US, and US will pay a transfer price of $10 million. And this entire thing will happen within 1 year. Now, the US-based company will be subjected to a corporate tax of 30% and a withholding tax of 10%. So, withholding tax is just like your tax deducted at source. That means 10% TDS will be deducted here, and the total corporate tax rate would be 30%. This will not be eligible for tax credit in US. That means if any taxes are to be paid in US, they will be paid further. They will not be eligible, these payments will not be eligible for tax credit in the US. The US company will sell the software developed for 12 million. So what is happening here is it is setting up a unit in India, developing a software, buying that software for 10 million transfer price, and then selling that software in the US market for 12 million. So 2 million is the profit in the US, undoubtedly, provided that the cost of manufacturing in India comes out to be less than $10 million. So the US company will earn two profits. One, the difference between this 10 million and the cost of developing the software in India. And then this 10 million will be further sold in the US market for 12 million. So let us first calculate what is the cost of manufacturing or developing this software in India. These estimates are as follows. There will be rent for a fully furnished unit with necessary hardware in India. All these figures will now be in rupee terms. So 15 lakh is what you are paying for the rent of a fully furnished unit. Then manpower would be required. There would be 80 software professionals. They'll be working 10 hours each day, and 400 per man hour would be the payment that is made to them. There would also be administrative costs, that is 12 lakhs rupees. Then you have to advise the US company on the financial viability of the project. The rupee dollar is expected to be 48 rupee per dollar, and we'll assume 365 days a year. So we'll make another assumption that all the 365 days are working. Okay. So let's see what is the cost of manufacturing or so cost of developing this software in India, which has certain parts like rent, manpower, and administrative cost. And then we'll convert it into how much is the profit is for the US company. So let us assume that the revenue from software in India as taxes are to be paid in India. So what is the revenue from software developed in India? It's US dollar 10 million. We'll convert it into an exchange rate of 48 as given here. So the rupee dollar rate is rupee 48 per dollar, and the US dollar company will give you US dollar 10 million. So it is 480 million in terms of rupees. Okay. Next would be the cost of developing the software. One thing is rent. Second is manpower. And the third is administrative costs. See, these are the three costs: rent, manpower, administration. Rent is how much? 15 lakhs. Manpower is 80 professionals, 10 hours each day, paid at the rate of 400 per man hour for 365 days. Rent is 15 lakhs, manpower is 80 men working 10 hours a day for 365 days. These are the man hours paid at the rate of 400 per hour. You can show it separately as a working note. So when you do developing a software, the major cost that comes up is for ₹11 crores 68 lakhs is the manpower. Administrative costs were simple, 12 lakhs. So 15 lakhs plus 12 lakhs plus 11 crores 68 lakhs. ₹11 crores 95 lakhs would be the total cost. Therefore, if you deduct all the cost, earnings before tax ₹36 crores 5 lakh. Now there is a corporate tax. At the rate of 30%. So you'll have to pay a corporate tax of 10 crores 81 lakhs 50,000. So after deducting the corporate tax, the balance left with him is 25 crores 23 lakhs 50,000. There was also a 10% withholding tax. Now we can assume one thing, that if he pays a 10% withholding tax first, then later on, which can be adjusted at least in India, so he will need to pay only 20% corporate tax. Or we can assume that alternatively that there is a further 10% withholding tax out of this. So another 10% withholding tax on 36 crore that will also be deducted. So if you calculate what is his cost of manufacturing cost of developing the software in India. Let's say the 30% includes the 10% withholding tax. So his total cost comes out to be 11 crores 95 lakhs. And he is able to, and together with tax, it is 11 crores 95 lakhs plus 10 crores 81 lakh 50,000. So his total cost comes out to be 22 lakh 76,000, 22 crores 76 lakh 50,000. This if we divide by the exchange rate 48. So it's just 4.74 million. Okay. We can say this is his profit. So if you will calculate the profit, 25 crore divided by 48, all these can be later on converted into dollars. You will see that $10 million and 25 crores divided by 48. It's 5.2573 is what he is left with. So the cost is 4.7427. Okay. Although alternatively, you can say that there could be another 10% withholding tax because sometimes the countries block the funds or withheld the payment or will not allow the repatriation of the funds outside the country. However, this is what the scenario is. So the US company will be able to generate substantial profit by getting the software developed in India. One, because it's costing him only 4.7427, assuming that the corporate tax includes the withholding tax of 10%. We may first deduct the withholding tax and then he may later on pay the remaining corporate tax of 20%. But no matter what, whether you deduct first withholding tax of 10%, later on pay the corporate tax of 20%, the total figure for the taxation would come out to be 10 crores 81 lakh 50,000. So together with 11 crore 95 lakhs and 10 crores 81 lakh 50,000, his total cost comes out to be 22 crores 76 lakhs 50,000 something, which is just 4.7427 million. So if you look at the broader perspective from India, he earns 10 million minus 4.74, 5.2573, and then if he is actually able to sell the software in US at 12 million, he will be generating another 2 million there. Okay? Right?
Yes.
Any doubt or any questions, sir? So this is a US-based company planning to set up software development unit in India. This will be bought back by the US at a transfer price of $10 million. And this will be done within a year. 30% corporate tax and a 10% withholding tax. So even if we consider another 10% withholding tax of 3 crores 60 lakhs 50,000, then also the cost will escalate a bit, but despite that it is very profitable. So you can show it alternatively that he's paying 30% corporate tax as well as 10% withholding tax. Or you can say first he's paying 10% withholding tax and then additional 20% corporate tax. So withholding tax is adjusted when he's making the final payment of the corporate tax. which generally is the case. So all you have to do is to calculate the cost of developing the software in India, which is 15 lakh plus 80 into 10 into 400 into 365 plus 12 lakh. Then when that is subtracted from 10 million transfer price, you end up getting 36 crores 05 as the profits before tax. After adjusting tax, the US company is still left with 25 crores 23 lakhs 50,000, which is still 5.2573. So the cost of manufacturing the software by the US company is $4.7427 billions. So therefore, it is hugely profitable for the US company to get the software developed in India. Advise the US company on the viability of the project. Yes, the project is definitely financially viable because the cost of developing the software is in India is coming out to be only $4.7427 billion. Okay. Right. So we can take a short break here for 10 minutes and let's resume after 10 minutes. This next question here, where XY Limited is engaged in a large retail business in India. It is contemplating for expansion into a country of Africa by acquiring a group of stores having the same line of operation, that is in India. So X Limited is a company and it is doing a large retail business in India. Now it's thinking about expanding into Africa, and there also it wants to acquire a group of stores which are also having the similar line of operations. The exchange rate for the currency of the proposed African country is extremely volatile. The rate of inflation is presently 40% a year. This rate of inflation will be related to the African country currency. Why? Because it's saying that African country is extremely volatile, and then immediately it is talking about the rate of inflation, 40% a year. Further, inflation in India is currently at 10%. The management of XY Limited expect the rates likely to continue for the foreseeable future. So we are not expecting any changes in the inflation rates or in the inflation rates in India or Africa. They will continue to be same in the foreseeable future. Here, the relevant thing that would be applicable for us would be the purchasing power parity. We have done it in Forex. So as per purchasing power parity theorem, we will calculate the theoretical exchange rates that should be if purchasing power parity holds good. Theoretical exchange rates. So they would be 1 plus inflation in the domestic country divided by 1 plus inflation in the foreign country. Spot multiplied by that. So we will use this formula to calculate the theoretical exchange rate for the next foreseeable future using the exchange rate in India at this is 40% and this is 10% in India. So estimated projected cash flows in real terms in India as well as African country for the first 3 years are as follows. Okay, important thing, real terms. So these means these are not inflated, right? These are before inflation, real terms cash flows are this. So these are to calculate the nominal cash flows, they must be adjusted and adjusted for inflation. So these are the 3 years. Year 0, initial investment in India. In year 1, in year 2, in year 3. So in India, it seems that the 0 year will take some investment. And in year 1, 2, 3 also, there are negative cash flows. However, the cash flow in African rand, in the 0 year, it is 200,000. All figures are further into 1,000. Year 1, it is plus 50,000. Year 2, it is plus 70,000. And year 3, it is plus 90,000. But all these cash flows are in real terms. So we will need to find out what exactly cash flows are. X Limited assumes the year 3 nominal cash flow will continue to be earned indefinitely. So we have a concept of perpetuity here. We have just done that. How do you calculate the price of a share using the dividend price model? It was generally D1 upon KE minus G. If you recall that we have calculated the cost of GDRs using almost the same formula, where P0 is the net proceeds or the price of the share today, T1 is the expected dividend after 1 period, and cost of equity minus growth rate. However, if the price of the share is to be found for unlimited time period, like if it is a perpetuity. So we'll divide. Straight away we will see that d1 divided by k minus g. So when you have perpetuity, you remember, if you recall your foundation classes in quantitative aptitude, you must have done the GP formula. So when there is an infinite GP till perpetuity, you simply divide by k, right? Or the indefinite returns. So XY Limited assumes that there would be 3-year nominal cash flows. The third year figure will continue to be earned till perpetuity. So this is not to be evaluated for 3 years. It is to be evaluated till perpetuity. But there is fluctuation from year 1, year 2, year 3. However, at year 4 onwards, things will be exactly same as you have in year 3. So this will continue till perpetuity or indefinitely. It evaluates all the investments using nominal cash flows. So this was important, that the cash flows are given in real terms and we need to evaluate using nominal cash flows and nominal discounting rate. If we had real terms, real cash flows, we could use the real discounting rate. Remember, we have just done nominal will be always equal to real, 1 plus real multiplied by 1 plus inflation. So if you are using the real cash flows, you can use the real discount rate. If you are using nominal cash flows, you can use the nominal discount rate. There has to be consistency between the two. Do not use nominal cash flow and discounting rate applicable for the real rates. But in this question, as it is very specifically given, that you have to evaluate using nominal, so you will use nominal only, not the real. The present exchange rate is, African rand is 6 to rupee 1. So 1 rupee is equal to 6 African rands. Okay. You require to calculate the net present value of the proposed investment considering the following. The African rand cash flows are converted into rupees, discounted at risk-adjusted rate. All cash flows for these projects will be discounted at a rate of 20% to reflect its higher risk. Ignore taxation. So what is the risk-adjusted discount rate? 20% for India. Ignoring taxation. The present value factors at 20% are given. So if the present value factors are given, you will always use those only. Otherwise, you will calculate till 4 decimals or 3 decimals, whatever you calculate, you will mention that you have rounded off till that number. However, when it is specifically given, you will use specifically this only. Generally, they are given in the questions, so don't have to calculate immediately. All right. So what is the crux of this question? Number 1, inflation in Africa, 40%, and inflation in India, 10%. Which currency is at a premium or discount? African rand upon INR is given to be rupee 6. Sorry, African rand 6. Present exchange rate is African rand 6 to rupee. Okay. Second important point given in this question is that the cash inflows are real. And question has to be evaluated using nominal cash flows. So all the real cash flows are to be converted into nominal. Using what? Inflation rates in the country. Final calculation has to be done in terms of rupee. Okay. So we will prepare first working note where we will calculate the exchange rate of the African rand to INR using the inflation of 40% in Africa and 10% in India. So here the domestic currency, this is foreign currency and domestic currency. So, or direct or indirect currency you can take. So let's take this. Exchange rate after year 1, year 2, and year 3. You can also draw this vertically rather than taking it horizontally. So spot is given African rand divided by Indian rupee is 6. So this will become 6 into what is the inflation in Africa? 1.04, 1.40 and 1.1. So after 1 year, the price of African rand would be, exchange rate would be, we have seen that the country 1.7636. We know that the country where the inflation is higher, that country is currency is at discount. So here the rupee is at premium. Rupee has increased or strengthened from 6 to 7.636. Year 2, we'll use 7.636 as base. Multiplied by 1.40 upon 1.1. Year 2, the exchange rate would be 9.719. And in the third year, 9.719 into 1.1 into 1.4 divided by 1.1. It would be 12.369. It's 9.719 into 1.4 divided by 1.1. You could have also presented it vertically. Year 0, year 1, $7.636, then 7.636 into 1.4 divided by 1.1. This could have also been done by using 6 only and squaring this, okay? So this could have also been shown as 6 into 1.4 divided by 1.1 square, and the next one 6 into 1.4 divided by 1.1 cube. Okay, so these are the 3 exchange rates which we will be using. Then inflation factors will also be required to be calculated. In India, year 0, year 1, year 2, year 3. So it's 1, then 10%, 1.1, 1.1 into 10%, 1.1, 1.21, and 1.21 into once again 10% inflation, 1.33. Similarly, in Africa, 1, then 40% inflation, 1 into 1.4, it will become 1.4. Then 1.4 into 1.4, after 2 years, it will become 1.96, and 1.4, again, it will become 2.744. So two things are important. Need to have the inflation factors and need to have the exchange rate calculated using the purchasing power parity, expected spot exchange rates. Okay. Once this is done, let's move on to the creating a solution. Cash flows in India are minus 50,000, 1,500, 2,000, and 2,500. I will not write inflow or outflow. I'll just write cash flows, real, in thousands. Cash flow nominal. Once again in rupees, thousands. You will multiply by the inflation factor to get the nominal cash flows. 1,500 into 1.1. $2,000 into 1.21. And 2,500 into 1.331. It's 3327.5. I have rounded off. Next, you have Africa, inflation factor. So we'll do the same thing, but we'll do one additional thing. That is, convert the African rand to Indian rupee. Minus 200,000, 50, 70, 90. And inflation factors are 1.4, 1.96, 2.744. Once again, cash inflows cash flows, real in African rand and in thousands. Minus 200,000 plus 50, 70 and 90. So this one is a plus. Cash flows in African rand real converted to nominal. What we will do to convert to nominal? Multiply by the inflation factor. $50,000 into 1.4. 70,000 into 1.96. And 90,000 into 2.744. Converted into rupee. So 200,000 divided by, you can write the exchange rate in the beginning also. 6. Then it would be 7.636. $9.719 and 12.369. So 200,000 divided by 6 is equivalent to minus 333.33 Indian rupees. These are again in thousands, remember that. So 0-year outflow in India is minus 83,333. Okay. This is the net outflow or inflow in terms of Indian rupee. Here it is plus 70,000 and the exchange rate is 7.636. So 70,000 divided by 7.636, it's plus 9,167 Indian rupee and it's minus 1,500. So net in terms of rupee becomes 7,667. Second year, African rand 137,200 divided by 9.719 converted into Indian rupees, we have plus 14,116.67. I'll round off to 117. And the outflow in Indian rupee was minus 2,000. Here we have plus 14,000. So when you subtract 2,000 from this, net, it's plus 12,116 or 117, sorry. Last year, African rand inflow 246,960 in nominal terms. divided by the exchange rate of 12.369. It's plus 19,966. And 19,966 minus 2,500 still have a positive 17,466. So these are the final inflows or outflows in 0 year and first, second and third year in Indian rupees in thousands. Next, the discount rate to be used is 20%, and these are the PVIF factors given: 0.833, 0.694 and 0.7579. But you remember 19,966 is what you will be getting till perpetuity. Okay? We have seen that year 3 inflows will remain constant, will remain similar till indefinite period. So 19,966 is what we are getting. This will remain constant forever. Let's look at the PVIF factors at 20%. So it's 1, and then it's 0.833, 694, 0.833, 0.694, and last 0.579. Okay. So you can actually calculate. I'll use this place here. What is the present value of inflows in the year 1 year, second year, and third year? So the present value of the first year inflow is 6386.6. $8,409. And 10,112.81. So I'll keep it 30. This I can round off to 7. And this is minus 83,333. So if you consider year 0 outflow and summation present value year 1 to 3, so you have 6387 plus 8409 plus 10113. It's 24,909 as the inflow. All figures are in thousands. Remember that. Continue to write that. And 83,333 is the outflow. So by looking at year 1 to 3, the total outflow so far is net NPV after third year. There is still a loss of 58,424. Now we will look at what happens in perpetuity. So we expect the perpetuity to give us a constant return of 19,966. That will be discounted using the factor of 0.20. So you're going to get 19,966 till perpetuity, present value of perpetual returns. all these have been divided by 1 plus 0.1 divided by 1.2, 1.2 square, 1.2 cube. But this will be divided by 0.20. So this becomes 99,830, and this will be further multiplied by 0.579. So it's 57,801 in the positive here. So overall NPV comes out to be 58,424 minus 57,801. So still there is a loss of INR. Okay. That means the project is not worth accepting. It's giving a negative return. I hope whatever we have done is clear. I'll quickly recap. XY Limited is engaged in large retail business in India, contemplating for expansion into a country of Africa by acquiring a group of stores having similar line of operations which are there in India. The exchange rate of African country is very volatile. Inflation is 40% a year, whereas in India it is 10%. Management expects that this will continue for foreseeable future. So first thing we will do is, using the spot exchange rate, we will calculate the exchange rate of the African currency for the next 3 years using purchasing power parity. Then second important thing in this question is that the cash flows are given in real terms, but it has been specifically asked that we will evaluate the project using the nominal cash flows and the nominal discount rate of 20%. So in India, in all the 3 years also, there is a negative inflow, negative cash. In the 0 year, obviously, it was minus 50,000 into 1,000, whereas in year 1, 2, 3 also, it's negative. If you look at the African rand and the cash flows in Africa, in year 0, it is negative, but in year 1, 2, 3, it is positive. These cash flows are for the first 3 years, and whatever we're getting in the 3rd year will remain same, continue for indefinite period. So using an exchange rate at 6 to begin with, you're required to calculate the NPV of the proposed investment considering the following. Number 1, convert the African rand into Indian rupees and use the discounted risk-adjusted rate of 20%, which is a high risk. Taxation is ignored. PVIF factors for 1 to 3 years are given. So firstly, finding out the exchange rates that will prevail in year 1 to 3 using the purchasing power parity. And secondly, calculating the inflation rates in India as well as in Africa at 10% and 40% to convert the real inflows or outflows into nominal. So I've written the exchange rate on the top line, 6, 7.6 and 9.7 and 12.36. Just for reference, you will use it later, so you can write it here. Year 0, 1, 2, 3, India inflation rate, India's cash flow in real terms, India's cash flow in nominal terms, calculated by multiplying the real cash flows into 1 plus inflation rates. Similarly, we will repeat this for Africa, but one extra step that we will take is using these exchange rates, convert the African rand back to the Indian rupee. This will tell us what is the net figure that we have in inflow or outflow. So year 0 was net outflow of 83, 50 plus 33. Year 1 was net inflow of 9167 minus 1500. Year 2, 14,117 from Africa, minus 2,000 from India. So 12.
I have a question here.
Yes.
Why are we adjusting with 1500, not 1650?
Why are we
Because both
adjusting
are
with?
nominal.
Why are we not?
We have to adjust nominal with nominal. Na? So cash flows real, we are adjusting.
Right. Sorry. This line is to be taken. You're right. Nominal will be adjusted with nominal. So sorry. So 9167 minus 1650. 7517 would be the answer. Nominal will be adjusted with nominal. 70,000 converted into African rand converted into Indian rupee 9167, and nominal Indian was 1650. So 7517 is the net. Next, 14,117 minus 2420. 11,697, and third 19,966 minus 3328. 16,638. Then using the PVIF factors 833, 694 and 579. It's 9,633. This is 8,117. I keep it 118, round off. 0.833. 6262. So 6262 plus 24013. So it is 24,013 minus 83,333. So your outflow is 59,320. And even after this, inflow of perpetuity, which is 19,966. Sorry, this will be again the net figure. 16,638. Divided by into that's 83,190. And that will be brought to 0 here. So into 0.579. It's 48,167. So still there is a loss of 11,152,153 approx. So the project is not worth accepting. Okay. So similarly, we have calculated the cash flows of nominal in India, then Africa, but Africans are converted into back to Indian currency. And then we have done the netting. So minus 50 and minus 33. Then you have 9167 minus 1650, 14117 minus 2420, and 19966 minus 3328. So 16638 is likely to continue for indefinite period of time. So first we calculated the present value of these three, and to that we added 16638 divided by 0.2 into 0.579. So that's the total value of inflows, 48 plus 24. And 48 plus 24 is also less than your initial outflow of 83, which means there would be a deficit of 11,153,000 Indian currency. Therefore, the project is not feasible. So you're required to calculate the NPV. The NPV is negative. Therefore, it's not worth accepting the project. Right? Good. Thank you for bringing
But
up.
the NPV is coming positive, I think.
Negative. I'll just erase this and mention it again. See, what is happening is, first we have calculated the cash flows. Year 0, 1, 2, 3. So it's minus 83,333 plus 7517 plus 11,694 and plus 16,638. These are all in terms of INR 1000. Right? And from 4th year onwards, it's going to be 16,638. PVIF factors 1, 0.833, 0.694 and 0.579. So we'll calculate for year 1, 2, 3. Year 1, 2, 3, it comes out to be 6262, 8118. and 9633. For fourth year onwards, there's a perpetuity. So generally, when you have, let's say, how did you calculate this first year inflow? Year 1, cash flow of year 1 divided by 1 plus PVIF factor or discount rate at of 20%, right? So you had 7517 divided by 1.20. 1 divided by 1.20 gives you 8.833. So you can also multiply by 7517 into 0.833. But as you remember in geometric progression, if there is an infinite GP, we have the summation is just given by A upon R. Rather 1 minus R and 1 plus R, so on. It's just R. So in here also, when you have a constant dividend, so or the constant cash flows till perpetuity, you simply divide by the discount rate I, or you call it I or discount rate. So 16638 will be divided by 0.20. So this will give you the present value of this at the end of third year. How do you calculate the price of a share? The dividends till perpetuity divided by KE, right? So these are the dividends which will keep on getting perpetuity. But if it is D4, you end up getting P3. Now, but we have to evaluate here at 0 year. So this is again to be brought at 0 year. So this will again be multiplied by the PVIF factor of 20%, 3 years. Okay. So 16638 divide by 0.20 and multiplied by 0.59579. So either I could have added 16638 here itself. Okay. Got it? So when you will calculate, it comes out to be minus 8333. First you will calculate this thing, 16638 divide by 0.2 is 83190 into 0.579. So the present value of perpetuity becomes at 0 year 48,167 plus all this 6262 plus 8118 and 9633 plus 48,000. So when you will add all this 6262 plus 8118 plus 9633. So the present value of total inflow is 72,180, whereas the outflow is 8333. So present value of outflow minus present value of inflows. You are left with 11,152 in the negative. And remember, we have done all calculations in rupees, thousands. So it's a huge loss. Therefore, the project is not viable. Right? So it's coming out to be negative. Okay?
Yes, right. Got it. Thank you.
So if you have any doubts in the questions that we have covered so far, you may please ask. Otherwise, we'll take up the next questions in the next session on Tuesday, Wednesday. Let's do a few MCQs here. By looking at these MCQs, I also intend to explain to you what is the meaning of all this. So which of the following is an international source of finance?
All of the above.
All of the above.
All of the above. So what are foreign currency convertible bonds? So look at the word bonds. It's a debt instrument. Convertible means that at the time of maturity, they might not be redeemed. They might rather be converted into equity. The third word is foreign currency. So bonds, which are convertible into a different instrument or equity or some other at the point of redemption, which are expressed in foreign currency. So the issuer has local currency is different from the price or the money which he has received by issuing these convertible bonds is a foreign currency. These can be puttable or callable. You understand that? What is the puttable bonds and callable?
Yes.
Puttable, the
Right to buy, right to sell.
So the investor will give his money back, will ask the company or the issuer that I want to get back my money. And if it is callable, the company or the issuer will say that I'm redeeming your money and calling back the bonds. Right? So bonds will get in between redeemed. Second is GDRs, Global Depository Receipts. Is the concept clear?
Yes.
So global depository receipts, like for suppose, yes, you want to say something?
Yeah, I wanted to say that the issuer deposits the shares with a depository bank in a foreign country, then that bank issues GDR
Depository
or
receipts.
ADR.
So if it is in America, it is ADRs. Otherwise, it is in different other countries, it will become GDR. So if an Indian company wants to raise money from the investors in US, it will deposit its equity share with the custodian bank in India, and a depository bank in US will, basis that, issue the shares or depository receipts to the US citizens in US dollars. Then you have euro convertible bonds. Concept clear?
Yes, same convertible bonds, but in the euro.
Yeah. And
Equity
so
shares into
right. All these are the international source of finance. Besides, you can also borrow from countries outside India. Second, which of the following is used in multinational cash management? Yes?
I think all of the above.
Yes, all of the above is still the answer. All of the above are used in multinational cash management. Let's discuss one by one. What is netting? Netting can be bilateral or multilateral as well. Bilateral or multilateral. How does it happen? Let's say X is a company in India and Y is a company in US. If they have exchanged goods between themselves both ways, okay? So if Indian company has sent goods to US worth $20,000 and US company has also sent to India some goods worth rupees $15,000. So netting would mean that the US company does not need to pay $20,000 and then back Indian company again paying a $15,000. Netting would be that only the US company pays $5,000 to the Indian company X. In multilateral, there would be different countries and different companies. So a final, all of the payments of all these companies and countries would be adjusted, and a net figure would be found that this particular company in, let's say, US has to receive these many dollars. This particular company in Japan has to pay these many dollars or yen. So that would be netting. Okay. So all the receipts, all the payments, and a net figure is found whether finally you have a payable or a receivable. That is netting. How does it help? Don't need to convert your currency again and again. Then exchange risk fluctuation is restricted to only $5,000, not on 20,000 plus 15, not on $35,000. So the political risk, exchange risk, all this gets reduced, and you don't need to convert your money into a foreign currency to make the payments and receive the payments. Next is leading and lagging, a concept in cash management. What does it mean? Leading and lagging. What does it mean? Okay, I have a balance sheet and I have US dollars 20,000 payables. Let's say in today's rate, it is 20,000 into 88. That is what something I might end up paying, right? What if dollar gets stronger? What if I think that the dollar may be at premium? So instead of 88, it will become 90, 92, any amount more than 88. So I'm expecting dollar to strengthen against rupee. Dollar is at premium. So if I delay this payment, I'll end up paying more. Lagging is delaying the payment. So if I try to delay this payment, it will be a loss to me. I will end up paying more because I'm expecting dollar to be at premium. But if I make the payment right away, immediately, or if I prepone the payment, even if it is due after 3 months, I say, no, I want to make the payment now. That is leading. So if I expect a foreign currency payable and that foreign currency is at premium, I will like to lead. That is a good concept in cash management. You can utilize this to make payments of those currencies which are likely to, those foreign currencies which are likely to strengthen, and to delay the payment of those foreign currencies which are likely to be at discount. Okay. Third is managing the blocked fund. So sometimes it so happens that when you are investing in other countries, when you are having subsidiaries in other countries, those countries create certain bottlenecks for the parent company or the investor, and they tell them that you cannot repatriate the amount of profits you would generate in this our country. They can block the funds within the country where the investment is made. So a good cash management strategy would be to take care of those blocked funds also and manage them well. Only then you can make your cash management proper and predict or forecast your cash flows. So all are necessary for having an effective cash management when you're dealing with multinational companies. Okay. Next. A company in India has payables to the US in 6 months' time. Dollar is expected to be at discount against INR in 6 months. Company will prefer.
Leading.
Think about it and then answer. Take 1 or 2 minutes. Yeah, Neha has given an answer. Good.
Dollar is expected to be at a discount means
Means if today it is at 88, we are expecting it to be 82, 83, less than 88.
then lagging would be the answer.
Lagging would be the answer. So you have payables, right? So when you are going to make the payment, you want to make payment less. And in 6 months, you are expecting that the dollars would be at a discount. So even after 6 months, if you think it will be at more discount, you can ask them that we're not going to make the payment now. We'll pay you interest rather. So if you're expecting that dollar would be at a discount, you will like to lag your payment or delay your payments, right? What would have been the situation if it is receivables the other way around?
Then leading.
Then it would be opposite, right? Yeah. Okay. So if you have any further questions, you can ask. Otherwise, we'll complete the remaining questions tomorrow. Okay. I hope you are comfortable with whatever the questions we have done today. Any
Yes.
doubt? Okay.
So, but I don't have the assignment.
Okay, I'll just ensure that it gets uploaded.
Okay. Okay.
Any other question, anyone? We can have a quick recap of what we did. GDRs are clear, absolutely. How we calculate the number of GDRs to be issued and how we calculate the cost of GDRs, right?
Right. Yes.
We have 2 questions on this. They were same almost, right? So I'm sure you would manage. Then this one particular question was very important because the NPV was supposed to be calculated using a foreign currency approach. So normally if you do not pay attention to this clause using foreign currency approach, it becomes very simple. You convert the 11 million into 48, 22 million into 48, using the purchasing power parity as we have done for the African country. So 1.48 into 1.12 divided by 1.08. We could have calculated using the interest rate parity, the exchange rate in the next 5 years, converted the US inflow, cash dollar inflow into rupee, and then discounted using 14%. But no, the question is very specifically asking you to use foreign currency approach. So the final NPV has to come in dollars, and that you can later on convert it into rupee. And you don't need to calculate the exchange rate of the rupee for the next 5 years, as NPV is at 0 year and you have been given the spot rate at 0 year at 48. So what would you use this risk-free rate in US and in India to? To apply the risk premium on the US risk-free rate. So the first step would be to calculate the risk premium. As a layman, it appears to be 2%, as risk-free rate is 12% in India, but the required rate of return in India is 14%. So it appears to be 2%. But to be more specific, using the multiplicative model, 1 plus risk-free into 1 plus risk premium will give you the required discount rate. So using that, we were able to calculate what should be the risk premium. It turned out to be 1.79%. Applying this 1.0179 to 1.08, we got that the US will require a discount rate of 9.9%. Then it was simple. Using all the inflows and discount rates at 9.9%, calculate the PV, and NPV turned out to be a positive 1.011 million. Convert it into US dollar into Indian rupee using the spot rate of 48. So the project was worth accepting. Here, the US company was calculating whether it is fruitful to develop the software in India, where it has taken a transfer price of 10 million. So if it was profitable, 10 million minus converted into rupee and subtract all the cost, give the corporate tax. You can also deduct another 10% withholding tax. Even after that, it was a 5.2573 million profit. And even if you take another 10%, then it would be 4 point something million profitable in the Indian country itself. Then later on, when you sell the 10 million for 12 million to the US customers, it is another 2 million profit. So basically, the cost of this type of question should have a calculation where we're comparing the cost of developing the software in India to developing the software in US. Then we talked about the African country where there were different inflation rates as well as the cash flows are in real terms. So you need to apply the inflation rate to calculate the nominal cash flows and then apply the calculation of whether the NPV is positive or negative. So what we have done is calculated the exchange rates using inflation, purchasing power parity, and calculated the inflation rates. After that, first, Indian real cash flows are converted into nominal. Then African real cash flows are converted into African nominal, as well as after conversion converted into INR. Then a total net of India plus African operations, NPVs are found, cash flows are found, which is minus 83,7517 and all this. Once this is done, the PVIF factors at 20% are used. So at present it is 59,320 in the negative. Then we calculate the perpetuity inflows, which is 16,638. That will be till perpetuity will give you a present value of 48,167. So even after 48,167 plus 240, this doesn't add up to 83,8333. NPV was negative. Therefore, we cannot go ahead with this project. Okay. So the main thing was in this question was real rates, calculating the spot rates using future forward rates using purchasing power parity, and applying the concept of perpetuity. So whatever you get in perpetuity is equivalent to P3. P3 has to be brought back to P0. So therefore you have to multiply by 0.59579, the present value factor of 3 years. Right? Next we will do in next class. So if you have any questions or queries, you may ask. Otherwise we can call it a day for today. Any questions, any queries? If we have some time, we can also still look at this question. We can discuss the answer solution in the next class. In the meantime, I suggest you that please go through all the content which is there in your study material and practice questions, all of it. Okay. Okay, let's look at this question 6 then. Let's have a discussion on this. We'll solve it tomorrow maybe. A multinational company is planning to set up a subsidiary company in India. Okay, there is a multinational company. It is setting up a subsidiary company in India. With hitherto it was exporting. So what was happening is there was a US company and here is India. It was exporting goods here and selling in the Indian markets. But now it wants to establish a unit here, a subsidiary company. So what will subsidiary do? It will manufacture here and sell in the Indian market rather than getting imported from US and then selling in the Indian. In view of the growing demand for the product, because the product demand is growing and there is also competition from other MNCs. The initial project cost consisting of plant and machinery, including installation, is $500 million. So $500 million is the initial investment. The net working capital requirements are estimated to be $50 million. So we know in capital budgeting, the working capital is an initial outflow, but we assume that this will come back to us in totality in the terminal year. The company follows straight line method of depreciation. So depreciation would be 100 million for first all the 5 years period, whatever the period. Presently, the company is exporting 2 million units. So at present, what is happening? 2 million units are exported at $80. So 160 million is the revenue generated by this company from the Indian market and a variable cost of 40. So 80 minus 40, a net contribution of 40. The Chief Financial Officer has estimated the following operating cost and other data in respect of proposed project. Okay, so what is happening is at present 2 million units are sold at 80 and 40 is the variable cost. So the US company is earning 2 million into 40. But what is expected? To set up a unit here, with 500 million plus 50 million. So make an investment of 550 million and then sell units, but your variable cost will come down to 20 and your fixed cost will also be 30. So you will have a variable cost of $20 per unit and a fixed cost of $30 million per annum. Project's share of allocated fixed cost would be $3 million. And there will be another concept, allocated cost. Share of the allocated cost would be 3 million per annum. Must be aware that when you are evaluating the projects, some costs are irrelevant. Why they are irrelevant? Because whether you set up or not, this cost is either way incurred by the company. It is just that a unit has been set up, so some portion of the costs which are already incurred the burden of that has been passed on to this unit. So for our decision making, this allocated fixed cost of $3 million will be irrelevant. The production capacity would be 5 million. See, we are saying that there is a growing demand. So as the demand for the product is growing, that is why there is a need to set up the product unit in India, because now instead of 2 million, we expect to sell 5 million units. Life 5 years. So 500 million depreciated straight line in 5 years. That's why the depreciation would come out to be 100 million. Okay. So far the question is clear?
Yes, clear.
Earlier, the company was exporting and in Indian market, 2 million units were sold at 80, whereas the variable cost was 40. Now we'll set up a unit. 550 million will be the investment. Depreciation would be 100 million in 5 years, straight line basis. But the variable cost will reduce to 20 per unit, which was earlier 40, will now become $20 per unit. But there would also be a fixed cost of 30 million per annum, as well as a 3 million per annum allocated fixed cost, which we will not consider as part of any material information for the purpose of evaluating the decision. So now we will be able to sell 5 million units for the next 5 years. Continuing with the question, there is also an existing working capital investment for production and sale of 2 million units through exports. It was $15 million. So at present, the company is exporting to India. That is also blocking some part of working capital in this project, in this export. And how much is that working capital? 15 million. So when you stop exporting and when you start creating a unit and generating those units, manufacture those units in India itself in the subsidiary, this working capital will no longer be required. So this will be released. You will receive $15 million back. So this calculation, 500 million plus 50 million working capital, 550 will be reduced by 15 million and 535 million would be your initial investment. So this part, the impact of this will be that our initial outflow will be reduced by 15 million. Okay. Export of the product in the coming year will decrease to 1.5 million. Another important aspect. I was telling you 2 million exported at $80. Now this is not to be compared. Our decision is not to be compared with 2 million. Our decision is to be compared with 1.5 million. So there are some changes. Those changes have to be incorporated while evaluating the decision. So we will compare 1.5 million sales at $80 where the variable cost is 40 to now comparing with manufacturing and selling 5 million units. And the price of the manufactured units will also be kept at $80 only until and unless specifically changed. But now the variable cost would be $20 only. So the export of the company will also decrease to 1.5 million units in case the company does not open the subsidiary company in India. In view of the presence of competing MNCs that are in the process of setting up their subsidiaries. Corporate tax rate is to be taken at 35% and required return from the project is 12%. Assuming no variation in the exchange rate, and all profits will be allowed to be repatriated. No blocked funds. No withholding tax. Estimate NPV, the net present value of the proposed project in India. So no calculation in foreign currency. Everything is to be done in the Indian currency. PVIF factors at 12% for 5 years are given, rounded off till 4 decimals. So you will use these factors only. Right? I hope you've got some idea of how the question is to be attempted now. What you are supposed to do.
Yes.
You will create tables where you will have initial cash outflow, 535. Then you will compare the sale of units from the Indian manufacturers and the original decision of exporting 1.5 million now, which will be. So you'll compare the cash flows in 1.5 million units exported or 5 million units manufactured and sold. So you can compare the net cash inflows if they are more than the outflows at NPV of 12%, PVIF of 12%. If it comes out to be positive, you can go ahead with setting up the subsidiary in India. Else, you will continue to export. Okay. So we'll discuss this tomorrow. If you want to try it, it is good. I would appreciate if you try out this question at your own. But we'll discuss day after tomorrow on Wednesday onwards. Right? So that's all from my side. If you have further any questions, please ask.
Ma'am, done?
Yes, done for today.
Okay.
Right. Thank you. No questions, T? Students?
No question. Thank you.
No question, ma'am. Thank you, ma'am.
Thank you. I'll write the contact number and please take that. It is 3045. Ashikji, it is 3045956. I'll just verify. Give me a moment. And SFM dash final at ICAI.in. Team, just a minute. I'll verify the phone number.
अशोक जी सेशन ओवर क्या चीज वो हो गया
हो गया? Okay. Thank you. Right. Thank you.
मैम 1 second
Yes, sir.
sir has
Okay. Okay.
sir will conclude the session
Okay. Okay.
Thank you for the session. Sorry, I'm late a little bit. I'm just entered the office due to some reasons. Okay, so today you have done the half portion of, I think, international financial management.
Right.
Okay, rest of the complete in the next class.
Sure, sir.
Okay. So student, I think with this, in the next class, we will cover up the main topic of interest, basically international financial management, or we can say foreign exchange part will be covered, which is inclusive of the international financial management. So madam, just share the screen. I think you have shared the number. I will tell you. Yes, if you have
Yes.
shared. Okay. Okay. Thank you, madam. Okay, thank you, madam. And have a nice day. And thank you, students, for your patient listening and making the session interactive. Thank you, and have a nice day.
Thank you, sir. Thank you.
Thank you, sir. Thank you, ma'am.
Thank
Thank you. Thank you.
Thank you very much.
Thank you.